right, so hello all. My name is Shlomo Cooper, and we are right now on Thursday, our weekly webinar here on TradeNet, on the day trading room of TradeNet. Um, and last week we talked about the earnings season and how the earnings season is able to give you, to hand out for sophisticated investors and traders lots of money, and we are talking big money here. And the idea of uncovering stocks that are going to surprise with their bottom line profits ahead of the official announcement, it has long been the holy grail of Wall Street. So big investors and hedge funds have created expertise in spotting these stocks in order to collect big gains of 10% up, 15% up, and even 20% up. And we're not talking about weeks or months to get this gain. Probably we are talking about hours, maybe 1 or 2 days. So last week, I shared with you a knockout strategy for the earnings season. And today, on the second part webinar, we're going to gear up and show you how to anticipate which stocks are going to soar or to plunge ahead of earnings. So if you actually look today on NFLX, and NFLX surged upward today with 18% gains, 18% gains at the start of the day, or FFIV plus 15%. And let's just put here a chart. So just take a look right now today on NFLX. All right, NFLX, what a jump! Yesterday it was traded for 330. Right now it's 386. So this is $56 gain. Or take for example FFIV. FFIV shot up today at the start of the day, and it's gapped up by about 12%. And all the gains is right now, all these gains are right now in our pockets, logged in our pockets, and I'm going to show you exactly how you can know in advance that these stocks with a great probability are going to go up, or maybe going down for our shares. So we talked a little bit about it last week. And by the way, if you missed the webinar last week, I'm strongly suggesting you to review it and to just run it. So you can find it in our YouTube channel, and here's the link. You are more than welcome to watch it. And by the way, we have a great YouTube channel, and right now this is the link in the chat room, so you can just click on it and put it in your favorites for further review. So today we are going really to push you one step forward, and in the first couple of minutes, I'm going to just make a quick review on what we talked about last week, and then we are going to gear up for today's material. So actually, last week we went one step forward to the courtyard of the big boys, the scene of the hedge funds, and what we learned was that what the professional traders in Wall Street know to do during the earnings season. This is what we learned, and we learned also how the earnings season is turned to be actually the biggest party of the traders, and it's the biggest party 4 times a year, 5 weeks along each time. We talked that we have two methods how to produce mega profits from surprising earnings announcement in Wall Street, or from disappointing earnings announcements. And here are 2 ways of doing that. We actually talked last week on the first method, and the first method was the good method. we call it the good methods, where we are combining fundamentals and technical. So the good method actually is telling us, and this is a swing method, and in a minute we are going to push it up for guerrilla trading and day trading, and probably most of you don't familiar with the term guerrilla trading, so I'm going to explain this terminology. But the good method for swing is telling us buy every stock of a company that delivered surprising earnings and went up on the day of the news. So I want fundamentals. All right, this is the first thing. I want to see that the stock was able to exceed the analysts' expectations in terms of the earning, in terms of the bottom line, and also I want to see a green day for the stock, because these stocks are going to show a tendency to continue higher days and weeks after the announcement. And on contrary, if you have a stock that went down, that actually missed on its earnings, you should sell it. You should sell it short, because probably it's going down. Probably it's going down in the following days and months. So also here we want to a combination of two things, fundamentals and technical. I want to see a miss. I want to see a miss in the earnings, and also I want to see a stock that is showing me a down day after the news, because these stocks are usually showing underperforming the rest of the stock in the market over the next couple of quarters. So let's just show you a couple of stocks. I want to show you stocks that I took recently. Actually, part of the stocks I was able to enter in the last week. So after the webinar, actually, I know part of you actually really understood the method and were able to start making money, pull money out of the market on this strategy, and this is really, really great. And let's take a look on a couple of charts. So I'm looking right now on APOL 1 day. This is a daily chart. 2 weeks ago, Apple actually delivered its earnings, its surprising earnings, very, very good and strong numbers. And after the figures went out, actually the investors cheered Apple and sent it up really, 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 really high. And as we see at the end of the day, we have a nice gap up candle, a green candle from the open to the close. The stock went up. So what we are talking about on this method is to buy the stock after the first day. So you can use the opening price at the following day, or just do what I'm doing. I'm just right now, what I'm doing is sketching, is just drawing a line, a trigger line above the high of the day of the news, all right, above the high of the day for the news, the same day the stock actually delivered the news. This is around here. This is the level 31.94, and the trigger is hit about 4 or 5 days later, and we are there. So now you can use a stop below the day of the earnings, all right, below the low, or you can even use the entry day, as a stop. So I'm using the lowest, the bottom of the price at the entry date as a stop. So this is a very, very tiny stop, and from there the this is actually a print screen of the stock up to date, and right now we are 9.4% up in only 6 days. Let's move on to another example, and all of these examples, these are live trades in my account, BBBY short. Actually, we talked about it last week. We saw it gapping down after delivering very, very miserable figures. It missed the earnings, and Wall Street sent the stock down sharply on the day of the announcement. So exactly as we saw on a poll, just on the opposite, we are drawing a red trigger line at the bottom price of the earnings date, all right, and at the bottom price of the earning day, and 2 days after that, this trigger is hit, and there we are short. Now, again, I can put a stop loss, all right? I can put a protective stop above the highest level of the earnings day, or I can use the entry point, the entry day, the entry bar as a protective stop. So I'm just putting a tiny stop. I'm putting actually a much more tight stop above the high price of the entry date. So this is the entry day, and I'm using a protective stop above the high of that day. From there, from 68.83, that was the entry, 2 days after the earnings, it went down 5.5% in 7 days, and that is lovely. This is perfect. Let's move on to ENDP. Actually, ENDP is a stock I took in the last quarter. All right, so that was about 3 months ago. There we saw, you can see here at the early in November, it had a huge gap up, and usually novice investors, novice traders look on these huge, on these sharp gains at one day, and they are afraid. All right, they are going to the lines. They don't have the courage to step into the stock. But what I'm telling you is to go against your intuition. All right, against the laws of gravity. What I'm here to tell you is to think opposite to what you are used to think about these kind of stocks, because usually after these sharp gains, this is only the start of the movement. Usually this movement is going to extend itself, and as we can see right now in ENDP, the long was 58.23 above the high of the earning day. It was triggered about 3 days after that. Also here you can use a stop below the earning day or below the entry day, right? So you can alternatively decide which stop you want to use, the wide stop or the more tight stop. And from there, in 8 days, it went 13.5%. Not bad for a swing trade. In 8 days to make 13%, this is huge. And SLM, actually SLM, I entered just 3 days ago, so I'm still in there. SLM actually went down on the earning day really sharply. I draw there a line below the lowest price of the earnings day. It missed the earnings miserably, and I went into it. Was triggered one day after that. One day after that, I went into it at 24.50. 3 days after that, right now, this is a live trade, and I don't have even a partial yet, and I'm 6% in the money in 3 days. So this is really great. Let's just review your questions. So Jonko is asking, is this lesson will be up on YouTube? Of course, all of our lessons are recorded and are going to be uploaded to our YouTube channel. Travis is asking, do you use a trailing stop as the stock moves away? Absolutely, Travis. So if I'm showing you right now a BBBY, what I'm doing right now is I'm putting a trailing stop above the highest point of the previous session. So right now my stop, it's not a stop loss even, it's not a protective stop, it's a low profit point, all right, because we are already in gains territory, and the question has transferred from whether we are going to make a profit to how much money are we going to grab out of this position. So absolutely, I'm using trailing stops above the high of the previous session. All right, so I believe this is quite easy, and this is understood, and all this concept is simple. By the way, just be sure to use some sort of an earning center in order to know whether the stock actually actually was able to exceed the analyst's expectations or whether it missed the analyst expectations. So you can just go to cnbc.com. They have there a great earning center, or you can maybe use the CBS internet site. It's called Market Watch. I'm going to write it down for you, and there just go to try to find the earning center there, and you'll have all the information, all the figures you need to know in order to use this technique. Now, let's move to the great method. And the great method is actually telling us search for stocks that the earnings engine is whispering you that they are going to jump, they are going to jump, or and usually they are going to jump, or they are going to slump. So the idea to find stocks that are going to surprise or they are going to miss, um, again, it's being used extensively by the big boys in Wall Street. And first of all, let's understand what is TradeNet's engine, TradeNet's earning engine. First of all, you may download the TradeNet's earnings engine from our documents. So here it is again. There are hundreds of downloads so far, and if you haven't downloaded it yet, you are more than welcome. Let's go to the broadcast, and right now you see an Excel format. This is a huge database that contains comprehensive fundamentals and statistical data, everything you should know about the earning season. So I'm going to show you a little bit how to use this engine in order to make substantial gains out of it. So, and absolutely you are going to be literally one step ahead of the market. So as we can see, this is an Excel format. This, this Excel includes the company's expected report date and time, AM. That means the company is going to announce its earnings before the start of the day, before the opening bell. If we have here a PM, that indicates for us that the stock is going to post its earnings after the close of the market, and this is very important for us to know when to enter the stock, because here we are going to bet on the stock ahead of earnings. So in the good method, what we did is to go on the stock to take a direction after the stock actually did the first movement on the first day. Here we are actually going or betting on the stock ahead of the earnings. So we will see how we are going to use it in a minute. We have here the estimated earnings per share. This is the EPS bit rate, and we have here the historical bit or miss rate for both earnings and revenue. This is very important for us because with this information we can know what is the tendency of the company. Is the company usually is posting good earnings? Does it have tendency to beat Wall Street expectations, or maybe the tendency of the company is to deliver poor earnings? But now let's just understand what the percents here actually is telling us. So let's go on JP Morgan, JP Morgan Chase, and here we see that 84% of the time the company beat the analyst expectations. Now, if we have here 84 is very good, absolutely, but what you have to see here is a figure above 63. I repeat, any figure on the EPS bit rate above 63% is good, but on average, the long historically average is 63%. So on average, 63% of Wall Street companies are beating the analyst expectations. So we need to see a figure not above 50% as part of you may think. We need to see more than 80, more than 63% more of the average. On the revenue bit rate, we have here 57. This is about medium. This is not good. This is not really bad. The long average here is set on a 60. Now let's move on to the average percentage change on the report date. Here we have the gap. All right. So what is the average gap up or gap down for the stock after the earnings? Here we can see that JP Morgan is going up 0.7% on average after the stock is reacting to the news. This is very good actually, and any figure above 0.3% considered as a good figure. That means that as an investor, as a trader, I want to bet on this stock because it has good earnings here, all right? Usually it beats the analyst expectations. It also performing very well on the day after the news. Now, it's getting up 0.7%, but look what it's doing from the open to close. From open to close, actually the stock has a tendency to slide. On average, it's going down 0.42%. So there is no point for going long on the stock on the day of the earnings. Actually, we need to be there ahead of time. So if I know JP Morgan is going to deliver its earning on the 14th of January AM before the start of the market, before the start, actually in the pre-market, we are expecting it to gap up. That means that a night before, just before the closing bell, just before the closing day of the previous session, I am going to go to bet on it, to go long on the stock in order to achieve the gain. And this is an average. No, the average is the biggest liar in the world because the average doesn't really tells us what the stock is doing. The average is taking into account also all the misses. All right. So if we really are going to see here positive earnings, JP Morgan is going to go up not by 0.7%, but by a couple of percents, maybe 4% up, maybe 5% up. This is a technique I'm calling a guerrilla trader. Now, most of you probably know what is a day trader or what is a swing trader. Swing trader probably is holding a position overnight between 2 to 5 days, usually. A day trader is getting into stocks and out of stocks, but at the end of the day, is going back to cash. A day trader usually don't tend to leave stocks overnight. This is the meaning of day trading, to go back to cash at the end of the day. Now, what is the guerrilla trader? A guerrilla trader is a window of a time frame that no one has ever told you about it. A guerrilla trader is a time frame between the day trader and the swing trader. A guerrilla trader is holding a stock overnight. So he can't be titled as a day trader because he's going overnight with the stock. But he isn't either a swing trader because usually the time he spends in a stock is about a couple of minutes. All right, is a couple of minutes. But by the way, a lot of trades of the guerrilla trader is a shorter period of the average time a day trader is holding a position, and a day trader may hold a position between 1 hour to a couple of hours. A guerrilla trader a lot of time is just taking a position 2 minutes before the end of the day, and he's booking gains 2 minutes after the start of the next session. So a lot of time we see a guerrilla trader that is holding a position for 4, 5, maybe 10 minutes. That's all, but he's holding overnight. So here in JP Morgan, what I want to do in order to take advantage of this gap is to go long before the end of the previous session and to sell it at the start of the day. With this concept, let's see a couple of stocks right now. So first stock I want to see is Morgan Stanley. Let's go for Morgan Stanley and let's see what happened here and what the engine is actually telling us. But by the way, I'm just running with my presentation, and I'll leave time for Q&A at the end of the presentation. At the end of the presentation. So Morgan Stanley, we met Morgan Stanley last week on the 17th of January AM before the start of the day, and we are going over the fundamentals. EPS bit rate, very, very good, 70% bit rate, that is good. Also on the revenue bit rate, this is quite solid numbers. Usually it's gapping up 0.75%, and more on that, and on top of that, from open to close, it has a tendency to go up. This is very, very, these are the numbers I want to see. These are the numbers I'm willing to take into my account. So what we are doing here in this technique as guerrilla trader, I'm going to long it before the end of the day. That means to take long on it on the 16th of January, one day before the earning release, and I'm usually selling it at the start of the day. So let's see what happened to Morgan Stanley. I'm just clicking here on Morgan Stanley, and let's go to the 17th. And as we can see, all right, Morgan Stanley actually opened the day 4.5%, 4.5% up. This is a great start of the day if you are taking Morgan Stanley. You don't have to sell it right at the open. Usually, what I'm doing here is I'm waiting the 5 minutes, and I'm putting a protective stop below the first 5 minutes. So if it goes, if the second 5 minutes bar goes below the lowest point of the first 5 minutes bar, this is what the point when I'm selling. But if it's keep going higher, I'm just taking the stop below any 5 minutes lows until this sequence is breaking. And here we can see on the fourth bar, this sequence was got broke, and here we actually went out. All right. All right. I'll talk about what if the company release bad news in a minute. All right. So in a minute, I just want you to see a couple of examples. Actually, I was in these examples. Let's go to Netflix. All right. You know Netflix, by the way. Netflix is one of the highlights in Wall Street today. NFLX. The engine tells us that it should release its earnings yesterday, the 22nd of January PM. That means yesterday night. It has great fundamentals 89% of the time. It beats Wall Street expectations. That is very, very good. And usually it gaps up at 0.6%. So it above 0.3%. This is what I like. So I have here a combination between the fundamentals and the performance of the stock on the earnings date. This is why I took Netflix yesterday as a long position. Now let's look what Netflix did today. And Netflix opened the day with 13% up. This is mega profit. 13% at the start of the day. This is $56 profit at the start of the day. I mean, you can close your screen 1 minute after the start of the day. So, but here, also here, I'm not tempted to take a quick profit. I'm just waiting for the 5 minutes bar to be closed. After that, I'm putting my protective stop, the point to lock profit below the lowest bar, and I'm just keep it higher and higher, and I'm just moving the point to take profits higher and higher below the sequence of the last 5 minutes bar. And here the sequence is broke at 390. This is where I booked profit. So actually I took it a couple of minutes before the end of the day last night, 3:33. All right. About 30 minutes in the trading day, I sold it for 390. This is almost $60 gain. Let's look on FFIV. Another example that I'm right now in the engine. The engine is really telling me, is whispering me what what which stock to bet, which stock is the right one to bet on. Um, all right, so this is 5 networks. Also, together with Netflix, it posted its earnings yesterday, 22nd of January PM after the close. You have here very solid EPS beat rate, and usually it gap up, wow, by more than 2.4%, and it has a tendency to push higher from the open to close, almost 1.7%. These are the figures I like to see as a trader, and let's see what happened for FFIV. So FFIV, it closed yesterday at around 97.37. So a couple of minutes before the end of the day, this is the point when you enter the stock, you sell the stock at the opening at $108. So that is $10 gain, $10 gain. But as I told you, I'm waiting for the first 5 bar to material. I'm putting my stop below the lowest point of the bar. So here I gave back couple of dollars of gains, and I went out at 105. But 105 to take it at 97. This is about $8 gain. Very respectable, very good gain. This is how I'm using the engine. All right, so now my suggestion, this is statistics. All right, you can't bet only on one stock. You know, you have to take into your account at least, I say, 5 stocks, because if you are going to the big sea, if you are going to the ocean, you can't go on a tiny raft. You need to go on a solid ship. So exactly this thing in the market, because from a statistical point of view, it's a 0 or 1. Because as a couple of you right now, you are writing in the chat room, a company that I'm betting on a long can actually go on the opposite direction. So I can't really rely only on one stock. This is statistics. So in order for me to get to the average of this technique, I need to take a couple of stocks, not only one stock. This is why I took today NFLX. I took Morgan. I took Netflix, NFLX, FFIV, and couple more stocks. All right. Any questions about that before moving forward? All right, so I'm just going to review because we have a couple of more things to share with you today, a couple of screens, right? So Nick says guerrilla trader. That sounds funny. All right. Uh, all right. And Hylin is asking, what if the company released bad news after the market close? So that's happening. And also, I'm using a 5 minutes bar. Even if there is a miss, and even if the stock is going in the opposite direction, if I'm waiting for a 5 minutes bar, usually this is the lowest point of the day, and from there the stock is actually going to recover. So if we are going to look on XLNX, for example, and this is what we saw yesterday. Let's say we took XLNX for long yesterday, and it went in the opposite direction. It went down and not up. But we are waiting for the first 5 minutes, and after the first 5 minutes, this is a green bar, and I'm putting. Oh, you can see it. All right. This is XLNX. All right, this is XLNX. It's starting with a green bar, all right, in the opposite direction, and just putting a stop below the low. If it goes below the lowest point of the 5 minutes bar, there is nothing to do. I have, I have to put up my hands and to say, this is the risk of making a business in Wall Street. This is the risk I'm willing to take using this technique. But in this example, in this example and many other examples, the stock is going up, it's closing the gap, and actually is turning into a positive. So this is actually a part of the game. All right. Um, Fred is asking, how often is this Excel file updated? All right, Fred. So actually, as you can see, right now I'm using the earning reports by date. All right, sorted by date. So if we will go together to the end of this engine, all right. So we have all the information in this engine, right? We have all the information in this engine till the first week of February, till the 7th of February. At the first week of February, we are going to update it with the second part. So this is the first part of the engine, and we are going to release another part of the engine at the start of February. And by the way, we are using this engine for more than 5 years, more than 5 years of experience. All right. Um, yeah. So Mike is telling us, so Shlomo, you should diversify. Absolutely. You're not going to take only one stock. You should take at least 5 stocks out of this engine anytime. Um, Darcy is telling us, I haven't made Guerrilla level yet. I'll try chimp training first, a smaller level. All right. All right, guys. So let's move up. Let's move forward. And I want to show you now a couple of screens, I made for you out of this engine. All right. So let's start and probably just give me okay if you can see right now screener number 1. And let's start talk about the screener. Um, right, and by the way, you are more than welcome to use a screen capture, right, to capture the screens, to capture these screeners, because I'm going to share with you a couple of ideas and couple of stocks and different styles of trading this amazing engine. All right. Mikey, all right, so you can see it. Couple of questions we have here in the chat room, Fred. Where can we download this updated file in the future? So, Fred, you can use the document. The documents button. This is the shared library of this room. Right now, you can download the Excel file, TradeNet's fourth quarter earnings engine, and I'm going to let you know once we have the updated file. But right now, we have at least 2 weeks in the engine, and as I said, next week we are going to release the second part of this engine. Mike is asking, Shlomo, EPS is the most important fundamentals factor? The EPS, right, absolutely. The EPS is the most important fundamental factor for me. Absolutely, yes. All right, so what I'd like to do with you today, right now, is to show you a couple of screenings from the database I made for you. And each screen is another trading concept we can capitalize on, and we will discuss each one of it. Let's start with screener number 1, the average percent change on earnings report days by sector. So from the earnings engine, I actually pulled the 1-day change on earnings for every stock that has reported over the last 12 years in order to see which sectors are the most and least volatile on their report days. So as shown, the average 1-day change on earnings for all stocks in our database going back to 2001 has been plus or minus 5%. All right, this is the blue bar here. So actually, what does it tells us is that in general, you can expect the stocks in your portfolio to move 5% upside or downside once per quarter when they release earnings. Unsurprisingly, technology stocks technology stocks are the most volatile on their earnings report days, with an average 1-day move of plus 6.7%. The consumer discretionary and healthcare, as we can see, they are ranked a second and third with their stocks averaging moves of more than a 5%, more than the average. Utilities stocks, the utilities sector, are by far the least volatile on the earnings, with an average 1-day change of just plus minus 2%, The second least volatile sector is the financials with an average one-day move of 3.5%. So this is a very, very general screener just to know where we can find the more volatile stocks. And as we know today, we had FFIV plus 13%, so we had NFLX 18%. So absolutely, they are coming from the technology. So absolutely, the technology is the most volatile and the most interesting sector to watch throughout the earning period. Now let's move to screener number two, and in screener number two we are getting into the mix. We are getting into individual stocks, and here we are searching for the most volatile stocks on earnings report days. So we take a look at the S&P 1500. It's not the S&P 500, it's the S&P 1500. It's three times the standard S&P 500 stocks that have historically been the most volatile on their earnings report days. And these are the stocks that have at least 10 quarterly reports in our earning engine database. So they have been around for at least 2.5 years. As shown, Netflix that we are right now on a trade on it today, a great trade on NFLX. As we can see here, it has an average move of plus minus 14%, so it's not surprisingly that today it's up 15%. DGIT, right? DGIT is the second one with 14% up or down. We have here ALGN, GMCR that you know, plus minus 13%, and other notable stocks that see big moves on their report days include Priceline, PCLN, RVBD, Crocs, QCO, Akamai. We have here also DEC, SanDisk, SNDK, plus minus 10.5%. This is very, very important, especially if you are trading, by the way, options, all right? Because if you are trading options, usually you want to get to the most volatile stocks in either direction. Let's move to the third screener. And in the third screener, screener number three, we are highlighting stocks with highest quality earnings since the start of the bull market. And in this list, we actually filtered our database to find the stocks that have been the most consistent earnings season winners since the bull market began back in March 2009. To make it into the list, a stock has to have beaten earnings estimate at least 75% of the time. It has beaten revenue estimates at least 75% of the time, and it gone up on its report day at least 75% of the time. And we are screening only for stocks above $5 per share with at least 5 quarterly reports in our database. So the database that we have, we can consider it as a valid statistics. You know, if we have only 1 quarter results or 2 quarters of results, this is not statistics. So we are making sure we have at least 5 quarterly reports in the database. So here are 24 stocks out of more than 2,000 stocks in our database that fit this criteria. This list actually is a good starting point of earnings season trading. And as we can see here, Kors, you know Michael Kors, Kors has an EPS beat rate of 100%. It has never missed. Also on the revenue beat rate, it has perfect results here. Also, it's up on the day 100%. Wow, what results. And usually it's going up 9% on the earning day. By the way, Kors is going to report its day, it reports its earnings on the 12th of February. So be tuned to Kors because it has perfect results 100% score on any given criteria. Also, price line that is going to report on the 26th of February has excellent results, a 100% EPS bit rate, 79% revenue bit rate, 79% up on day, and usually it's going up on average 5%. So just take this list, browse this list, and make sure to print screen it to capture the screen right now, so you will have all the stocks, all the figures, all the estimated report date, so you will be able to capitalize on this screener. Let's move on to the next screener, and in the next screener we are actually highlighting the highest risk stocks entering earnings. So this screen um, so you know, every trader has a story about a blow up when one of the successful trades misses earnings, and bearish moves of 15% or more happen to at least a handful of stocks every earning season. And hopefully this table will help you avoid a blow up in your portfolio, and if you are more aggressively, maybe to capitalize on a short there. So here we looked at stocks that are extended above the 50-day moving average by at least 7%, and this you can see on this column. On this column, you can see the distance of the stock above the 50 moving average. So that tells me the stock is strong. The investors are willing to pay premium for this stock. Also, we screen for stocks that beat their EPS and revenue estimated at least 2/3 of the time. When a name becomes overextended and misses earnings after consistently delivering, it can be enough to catalyze a big pullback. This is the screener. For example, MYGAN usually, MYGN, usually has a strong EPS bit rate, a strong revenue bit rate, and as you can see, it extended above the 50 moving average by almost 18%. It's going to deliver its earning on the 4th of February, and if it's going to miss, it's going to be a slump, it's going to be a plunge, and I'm not telling you to bet against MyGan unless you have any, unless you have a hint or you have a good information, good rumors about MyGan. But if you are going to sit down after the earnings, it's a good stock maybe to short from the opening. That means on the on the day trading time frame, to find a setup for short, because you know the stock is going to crush very harshly on these days. So we have here MyGan, QCore, SCSS, CTRP, and this is the screener. Let's move on to the fifth screener, screener number 5. And here we are watching the highest reward stocks entering earnings. So while missed earnings can catalyze big losses, bits can light a fire under any stock that is poised for jump. So this is a table with a list of 17 stocks that are trading right now near or below the 50 moving average, and here we see the distance of the stock below the 50 moving average. That indicates for us that the stock may be poised for a boost on a strong report, because if any of these names delivers an earning beats, as they have tended to do in the past, the positive move could actually knock the stock back above its 50-day in a heartbeat. These stocks all beat EPS, and they all beat the revenue estimates at least 2/3 of the time. They are all have reported 8 times or more since the start of the bull market, and they all trade at least $5 per share. So if we are going to take a look, for example, on FBHS, sorry. So FBHS has really strong fundamentals. 75% of the time it beats the earnings per share. 87% of the time it beats the revenue estimates, and 79% of the time it's going up on the day of the news release. Actually, it's going up by, on average, 4.5%. So this is very, very good. But guess what? On the daily chart, this stock is right now trading 6% below the 50 moving average. That means that if FBHS, it doesn't need to make, a thing it didn't do in the past. What we need FBHS to do is to do more of what it knows to do, of what it did in the past. And if it's going to deliver the same results as it did in the past, usually FBHS is poised for a big run, a big jump on its earning release. All right. Shlomo, could you tell me which stock screener that is on screen? All right. Didn't really understand. All right. Sorry. Okay. So Travis is asking. Oh, Travis is asking, can you show the prior screen again, please? No problem about it, Travis. All right. All right, and also AA, you can just print the screen, right? We make all of the screens. You may just print screen. And but by the way, if you need, you can just email me. And if you email me at shlomo at tradenet.com, I'll be most happy to send you all the 6 screens. All right, so you will have it on your under your hands. All right, so from here, I'm going to the last screen of this webinar, screener number 6, best reactions to raised guidance. And this is the final table in the earnings stock screening. And this is a summary of stocks that have reacted best to raised guidance in the past. You know that companies raising guidance can be even more bullish than beating analyst estimates, as management has access to performance indicators that analysts have to extrapolate. So 30 names here on the screen, they are all raised guidance regularly, and that means on more than 1/3 of reporting dates since March 2009. These 30 stocks also have a positive 1-day average and 1-week average returns following their earnings reports. So here we can see the performance after the first day and the performance after the first week. And that means gains from the increased guidance have tended to carry the stock consistently higher. All right, so this is very, very interesting stocks. Also here on the last column, you can see the estimated report date. And that means that if the tendency continues, this stock may absolutely be poised for a jump on the earning release. Very, very interesting screening to know, to put under your hands. Great and big companies like Philip Morris, PM, it's going to deliver its earnings on the 6th of February, and usually it's going, and usually after it's raising guidance, and usually tends to raise guidance, it's going up 3% on the same day, and it's going to extend the gains to almost to more than 4.5% at the end of the week. All right, so after 6 screenings, um, this is what we have for you for this webinar. Hopefully this is a useful information. Absolutely, don't hesitate to email me. if you have any questions or if you want to see any material in the following webinars. We are going to have more of these webinars in the future. As usually, this webinar has been recorded and we are going to upload it to our YouTube channel. You have a link to the YouTube channel in the document tab. Thank you all for being here with me, for studying. This is one of the major role of this room, not just to trade, but also to expose you to different tools, to the tools that the big boys in Wall Street are using. And actually, we want to share with you what we know after years of experience in Wall Street. So thank you all again for being with me for the last hour, and I'm going to see you, of course, on a daily basis in the trading room, and next Thursday on the next webinar. Thank you very much, and have all a good evening.